Hello and welcome to MasterChartsTrading.com market recap for the week ending Friday, December 12th, 2014. In this recap, we'll talk about S&P 500, which is down sharply for the week. There was a short signal generated in the Russell 2000 small caps index on Friday. Market breadth deteriorated, and I'll show you what it will take to turn this market breadth deterioration around. Treasuries closed on Friday at all-time closing highs, showing significant flight to safety. Gold is rebounding, but gold miners are indecisive, and they might just go either way. Oil and oil-related equities continue losing ground, and on Friday, ExxonMobil, a major oil firm, turned long-term bearish. It also hit a 52-week low. And then finally, I'll show you: are you truly safe in utilities during a market downturn? Because utilities are considered a go-to asset for the market downturns. Also, I want to show you that all of the charts, or most of the charts that I'm showing in this video, are located right there on the public charts list on StockCharts.com. This is a public information, so you can take a look there later on. So let's go to our charts, and this is a chart of S&P 500, a large cap index. It is long-term bullish, no doubt about that. So our buy signal was generated, the latest buy signal was generated on October 21st of this year, and we entered the market here. On average, we're up about 7.5 to 6% or so, 7.5% or so. We took some profits right there on December 8th, when price momentum oscillator rolled over. The reason why I took profits there is because this was a really extreme V-shaped recovery, and I definitely felt it was overbought at this point. Then also around here, the Apple came under selling pressure, and I actually covered this in my last week's video. Finally, Friday, December 12th of this year, we can see right here Arun surging to 100, making a move to the right there, and this is a signal for me to get out. See, get out. So right now we have zero exposure to equities, long equities exposure, we have none. We do, however, have some short exposure to the Russell. So this is a graph of Russell 2000 small caps index, and it is I believe it is bearish. It's my opinion that it is bearish. It turned bearish on October 7th of this year from the daily charts. I'm not showing in this particular video, but if you look on the public chart list, you can see that there is a daily chart of the Russell. In any case, on October 7th, this became bearish, and this rebound that started together with the rest of the market on 21st of October, it was a nice rebound, about 7 to 8% up, in line with the rest of the market. But this was a counter trend rebound, and I actually didn't even play it. I prefer to buy with the trend. It just provides for safer entry and exit points. In any case, it rolled over right there on 19th of November, and the momentum became bearish. Finally, on December 12th, and this Friday, you can see here that Arun surged to 100, maybe a little bump to the right. So this was enough for me to open a short position in the Russell. I'm playing it by buying inverse ETF called TZA. So I have a small position open right here. Right now, I mean, I would like to see a little bit more of a decisive close, maybe around here, and I'll definitely add more to this position, to the open position. Because Monday, especially if it gaps down on Monday, I will add significantly to the open position on Monday. If it starts to kind of go up and down and maybe just go sideways, I'll just keep the small position that I have open and then see how it goes. Since the market is deteriorating, the most logical place for money to rotate is the treasuries and other bonds as well, of course. But the treasuries is the most, it has the least correlation with the S&P 500. So this is the most logical place for money to rotate, especially in times of stress and indecisiveness. So for us, we had a preliminary buy signal on November 7th. We actually opened the position initially there, and then finally scaled into the market, treasury bond market, on the 20. Let me see, what is this here? 25th of November. Since then, we're up about 4.4% and have taken a little bit of profits right there because I felt like it may roll over. It didn't roll over, so I took a little bit of profits right there, but I have most of the positions still open right there. So bonds are gaining in the face of some kind of uncertainty in the stock markets. So let's take a look at market breadth. So on this chart, you can see clearly, especially right there, you can see this big red stick. And importantly, it closed at the low. In other words, people were selling into the very last minute, just trying to get rid of all of their stocks. This is quite bearish, and it looks quite bearish to me. We may see a rebound, but it's entirely possible we may gap down on Monday and just continue lower. And here's a really good indicator: is New York High Low indicator index, NYHL, symbol NYHL. So it already gave a warning signal on December 1st. There's a red stick right there. It kind of dropped in negative territory, and then all this week, 1, 2, 3, 4, 5 trading sessions. You can see that it was just lots of selling. Lots of stocks making new lows. Undoubtedly, many of those stocks are oil related. Excuse me. But still, nevertheless, this is a significant selling pressure. So what I would like to see for next wave up is first of all, the NYHL needs to go into positive territory. It's like, for example, right there or right there. And you can see those are nice bounces right there and right there. ITBM, intermediate term breadth momentum oscillator, will most likely drop into the negative territory. I just, the way I studied this indicator for a while, and it once it gets going to the downside, it just most likely will get to zero and minus territory. So this will mean that pressure will remain on the stocks for at least a few days to a few weeks. We'll see. I mean, this is a very bullish period in the year, so they might just turn around. And let me see if I want to say anything else about this. I mean, there are still bullish signs, like percentage of stock above 50%, 50-day exponential moving average, still positive, just barely though, 55% only. But the percentage of stocks above the 200-day moving average is significant. It's still about 72%. So, there's still bullishness out there, bullish breadth, and also the bullish percent index for S&P 500. It's still in the 72 area, so it's still quite bullish on this parameters. That's the reason why I'm not shorting the S&P 500, but I'm rather shorting the Russell 2000. I already showed this. So let's continue to gold. Gold is in a long-term downtrend. for for several years now. Right here is a counter trend bounce. The green rune surged to 100, made a little bump to the right. This would have been our entry. I'm not playing it right now. I honestly don't like to play it too much counter trend. So up about, let me see, the entry would have been about here, about 3.5% or so up. But if we look at gold miners, and you can see that there is still green is above red, so no short signal or any kind of obvious trouble, although it's been very choppy. But if you look at gold miners, different story. On the November, same date as the gold started going up, but then it really reversed right there on the December 1st was a huge gap down. And since then, kind of indecisive, just going back and forth, back and forth. So for gold miners, for me to turn, I actually opened a position in dust right there, small position in dust, DUST, which is an inverse gold miners ETF. So I'm short gold miners right now, but you can see it really went nowhere. It just kind of goes up and down, but sideways. And ideally decisive close above maybe $20 around here or so, or decisive close above below $18 or so would be would seal the fate, so to speak, short term at the very least. I am somewhat bearish and I have a position open in DUST. Oil related equities XLE continue their downtrend. The short signal occurred on December 2nd, and we were able to enter about here, and we're down. I mean, we're up for about 7.5% or so. So it's gaining for us really nicely. We're playing this by purchasing an inverse ETF called ERY, and it's going to be also in the blog, so you can read there. So far, important level 77.51 closed below that level, quite bearish still. And one of the biggest holdings, ExxonMobil, 16% of this energy select sector SPDR. So let me show you ExxonMobil next. So ExxonMobil, this is a daily chart. It was bullish since October of 2011, and since then it gained about as much as, let me show you, as much as 42%, but now it's to about 34%. So finally, this Friday, December 12th, so 2012, it made a 52-week low, first of all, and secondly, you can see here that the rune red came to the top and made a little move to the right there. So this is a very bearish indicator, bearish sign, and from here on, if I was playing this, I would be shorting the rallies. So let's look at the hourly chart of ExxonMobil. So up to, see, it still says that it's long-term bullish, and it was here, but right there on 12th of December it turned bearish. So I'm going to put a red arrow here for the next presentation. Right here on November 28th, we would have entered a short if we were playing this. I'm not playing this right now. So this would have been considered a counter trend short signal, because at that point right there it would have still been bullish, but from here on it's going to be bearish. So this is now becomes a short signal with the trend. So ExxonMobil is now bearish, and shorting the rallies would be a good idea until otherwise, until ExxonMobil turns bullish again. And finally, now let's look at the utilities. And utilities, it's considered a safety asset, so to speak, and this is a go-to sector during the times of when the stock market is falling, and it's something that's considered like a flight to safety kind of times. So it rebounded along with the market, even a little earlier, in fact. The rebound in utilities started October 6th, and it would have been up about 9% or so. So you can see that utilities are already losing steam, and they're barely kind of moving in a positive direction. And even though it's considered a safety asset, you can see that they lost almost a percentage point on Friday when the sell-off started to happen on Wall Street. But next chart, I think it would make even more clear indication of what I mean by um, that utilities may not protect you during this flight safety. So this is a weekly chart from 2007 until 2010. And so there are three charts here, three indicators, three charts. The one in black is the S&P 500. The one in red is the utilities. And finally, the one in green is the treasuries. So let's say you were, let me just show you. I'm going to remove the treasuries for just a second. And I'll show you what I mean when I say that flight to safety is a little bit strange to me, so to speak. So let's say you were in S&P 500 at, right there on December 2007 when the fall started. So let's say you were would you rather be in utilities at this point, or would you rather be in S&P 500? Well, my answer would be I would rather be in neither. I would rather be in cash because both utilities and the S&P 500 fell, from here to here. But let's take a look at treasuries. Would I rather be in S&P 500 utilities, or would I rather be in treasuries at this point, in December 2007? And the answer to that, I would rather be in treasuries, because right here, when the market started to collapse, the treasuries held up really well. They made a good buying opportunity right there, and then made a huge spike right there. So after the spike, of course, it went down, so you would have been really well off just selling your treasuries right there, waiting it out until utilities and S&P 500 rebounded. So in my opinion, the S&P 500 versus utilities, not much difference. You would be also, if the sell-off starts, if a significant sell-off starts in the stock market, both utilities and S&P 500 will be sold. And I don't think there will be much difference in utilities versus S&P 500. Maybe you'll lose less, but why would you want to lose at all when you can be in bonds? And on that note, thank you for listening, and have another great trading week. Please connect to us. Your following is really important to us. If you have a StockCharts.com account, please go to the StockCharts.com account, public chart list that we have here, and cast your vote or follow us there. And of course, if you have Twitter or Facebook or StockTwits accounts, here are our addresses there as well. And once again, thank you for listening, and have another great. Sorry. Thank you for listening, and have another great trading week. Goodbye.